Good morning, ladies and gentlemen, and welcome to the RBG Holdings PLC investor presentation relating to the litigation investment arrangement. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted anytime using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. And if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Nicola Forsten, CEO from RBG Holdings. Good morning.
Good morning and welcome, and thank you everyone for joining us today, where we're delighted to be detailing our recent announcement regarding our new litigation investment arrangement through our subsidiary Lionfish Litigation Finance. I hope I'm known to many of you in terms of my background, and I'm joined today by Tetz, who is my Managing Director and leader for our litigation investment division. And he's going to, I'm sure, outline a bit more about his background when he introduces himself a bit later in the presentation. Just a quick reminder about how the group looks today, if any of you are joining us for the first time in a few months. RBG Holdings owns RBG Legal Services, which is our legal services division made up of our current brands, Rosenblatt and Memory Crystal. That forms about 80% of the group today. And we own Convex Capital, our sell-side boutique M&A, and you'll see 90% of Lionfish Litigation Finance, which is the subject of today's presentation. And we have a small holding in an IT consultancy services business, which is sole purpose of which is to ensure our IT is either as cost effective or, if possible, cost neutral as possible. So turning just to our strategy, I always do in these presentations, just remind everybody of what the group strategy is and how we're tracking against that. The objective was to grow the legal services business, focusing on high margins and quality legal services businesses. As part of that process, to have selective M&A to build legal services or to diversify into other professional services as befits a broad-based professional services group, and to leverage our expertise in litigation to move into litigation finance. How are we tracking against that? We are, as you can see today, announcing a new litigation investment product within Lionfish, and we continue to offer litigation investment through our RBG Legal Services division. Tetz will touch on this, but just to remind everybody that RBG's investment in litigation is through its own client matters, where it takes them on risk and where we are able to work either at partial rates or for free, and where we're able to use our own balance sheet finance to advance disbursements to our clients in the ordinary course of business. It is through Lionfish that we invest in third-party litigation in cases through other law firms that are not part of our group. And at the current time, we have 5 litigation investments that we're holding on balance sheet for RBGLS, which at the half year, which seems ridiculous to be talking about the half year now, but at the half year, we had contingent WIP of 5.8 million and total cash invested of 4.9 million. We will be talking more about where we sit on these investments and the broader results of the group on the 28th of March, which is our final results day. So without further ado, I'm going to hand over to Tetz to take us through the deal that we announced last week.
Yeah, okay, thank you, Nikki, and good morning to you all. As Nikki said, my name is Tetz Shikara, and I have been the Managing Director of Lionfish Litigation Finance since we launched in May 2020. Now, I know some of you may already be familiar with our business, but this is, I suppose, for the benefit of being a reminder to all those who are new to us. The most important thing I think that I like to start off with is just to state our singular objective at Lionfish, which is to generate profits from real cash inflows. Now, this may seem an obvious statement to make, but most litigation funding businesses are founded and run by litigators. And if you ever spend any meaningful time around litigators, you'll quickly discover that as a breed, they're excellent at litigating, but are not necessarily the most commercial. My background is investment banking. I used to structure derivative and securitization transactions at ABN AMRO, Morgan Stanley and Goldman Sachs. My Lionfish board also has a very strong commercial mindset in Nikki Fulson and Robert Parker, who you know and don't need any further introduction to. And also on the board, we have Adrian Harris, who in my mind is one of the very few litigators with a very strong commercial background. So as a business, our mindset and our priorities are not what most litigators care about, which are things such as whether the case is worthy and relevant enough to be reported in the legal press, or whether it's going to set a precedent that changes the landscape of law, and so on. Our priority is simply to generate profits from real cash inflows. So on this slide, I wanted to illustrate this point by setting out at a high level an overview of what we see as the two broad type of funders in the market and how we differ. So the first in the table on your left are the listed funders. Now this table sets out the London listed litigation funders and their broad parameters of their operations. Now I won't go through the table, but if you cast your eye down right to the bottom of that, you'll notice the line item on accounting. And the key point here is that while we do fair value count because we have to, we report profits marking to cash and cash realizations only, which we have made possible through our investor sale business model. Now, this is, like I said, very important to highlight because we are not reporting profits based on marking up investments whose outcomes we cannot predict. We are reporting profits derived from real cash inflows. The second type of funders on your right-hand side are the fund managers who largely operate a typical, what's often called a 220 hedge fund fee model. Now, in this model, the managers receive a management fee, which is usually something along the lines of 2% of the funds they manage, the two, and then a performance fee, usually a share like 20% of the returns, but over and above a certain threshold, say a 10% IRR. What this means, though, is that as businesses, they have to prioritize deploying money and making investments, and often big investments with big upside returns, or what I would refer to as ultra-high value claims, because that's how they generate those management and performance fees that make their businesses viable. Now, litigation funding is, in comparison to other classes and other asset classes, it's actually quite a small asset class. So the fund sizes are also quite small, and the margins of some of these traditional funders, who are recognized as the leading players in our market, are therefore quite low. Now, most are private companies or LLPs, so their metrics aren't readily available, but I have on here two examples of funders from publicly available data who are very long established. Looking at the table, you can see just how low their PBT and margin metrics are. The key point, therefore, of this slide is that we may operate in the same market as these players, but our focus differs in that we drive our business with the goal of generating profits from real cash inflows. Now, moving on from the business models of funders to the market opportunity now. The market has grown enormously over the last decade, but the growth has been rather one-dimensional. Originally, litigation funding was an asset class, which was more akin to venture capital investing. So in other words, investing in a few ultra-high value claims on the hope that some would generate spectacular Tesla-esque returns. Now, 10 years on, and most of these funders haven't really evolved their business models. They're still raising monies, largely from institutional investors, on the promise of high returns to be generated from the same kind of ultra-high value cases. And this has created an oversupply of money focused on investing in these ultra-high value claims, where there is simply not enough of them, not enough deal flow, which is why many of the traditional funders are now spending more time and more resources than ever before trying to originate and develop investable high value claims. This is also exacerbated by the fact that law firms like Rosenblatt are also investing in these ultra high value cases themselves through the kind of damages-based agreements that they have entered into with Django and Mercury. So I actually believe law firms are much better suited to these ultra high value claims, because as the instructed solicitors, they can control and drive the litigation in a way that a litigation funder can't. So the traditional funders are facing even more competition for the ultra high value cases they're chasing. Now, the solution then would be for these funders to invest in more normal sized claims, but many of these funders can't, because they need these ultra high value claims to make their performance fees and business models work. Yet the reality in litigation is that most cases are actually not ultra high value. There are I estimate over 5,000 commercial litigation solicitors in the UK alone, and it's just the reality that most will never work on an ultra high value claim in their lives, much like most footballers will never play in the World Cup finals. So obviously, on the flip side of that, we can't fund too small a case either. But the £3 million to £50 million claim area, which are too small for some funders, is where, for us, the most attractive part of the market is, because there are more of them, and arguably these claims actually have better risk profiles. To put that logically, I mean, imagine a multinational that is facing, on the one hand, a £30 million claim, and then on the other hand, facing a £3 billion claim against them. That multinational will defend a £3 billion claim far more rigorously than a £30 million claim. I think just the other point to note is that as principal investors, i.e. investing money directly off our balance sheet, we keep the returns we make. But this means we don't need ultra high value claims, because we're not creating these returns only to pay them or to an investor who gives us a small amount of those returns as performance fees. Those returns that we make on a case are ours to keep, which means we can also be more intelligent and competitive with our pricing. So and that's why we can afford to and do play in a different part of the market from a lot of other funders who tend to play higher up the claim value chain, as I've tried to illustrate on the chart on that slide. Right. Now I just want to spend a few moments explaining how we position Lionfish within the broader litigation funding market. I mean, in short, the objective is to position ourselves as a fresh new generation funder or a must-go-to player. The fresh new generation part is obviously a cliche, and I said that last year as well. But in a market which is slow and dinosaur-like, it remains very impactful. The must-go-to part that is probably more important to understand, because the one thing that no one can control is when a specific lawyer gets a fundable case, which means targeted marketing in this market has a low hit rate. Instead, what's important is that we remain front of mind for when litigators need funding, so that when they have a case that needs funding, they think of Lionfish. Now, we do this by maintaining a very visible online presence through thought leadership and opinion pieces in the specialist legal press, which is very effective given how much lawyers like to read, and all of which are really designed to show that we think, review and articulate things differently to other funders. So that's how we position ourselves when cases arise. But the other part is what we do once there's a claim for us to look at. Now, currently, when a claimant or a lawyer goes to a traditional funder, they're all largely faced with what I would call the same pricing, same structure, same onerous process. There isn't really much distinction between them, but we differentiate ourselves by focusing on things that litigators, and that includes the litigators who largely run litigation funders, I would say are quite poor at, namely the customer services principles of speed, efficiency, competitive pricing, transparency, and delivery. Now, I won't go through the boxes on this page, but the key theme kind of running through the entire process is that at each step, reinforce those things that we preach. And for those who have experience of being on a trading floor, that's really the best analogy I can think of. So, that's us doing everything we do with a sense of urgency that combines the speed, the efficiency, and accuracy in a way that few other funders do. If we can go on to the next slide, sorry, thank you. Right, so having covered the market, the opportunity and how we're positioned within that market, I just wanted to touch on pricing. As I said already, the litigation funding market started with a venture capital investment mindset. So the idea that you make an investment for X% of the equity, or in litigation funding terms, X% share of the award. Now, we think differently in that we price according to committed capital and time. And the significance of this is that by doing it, we're potentially foregoing massive upside, but in return, ensuring that we get a fixed minimal return. Now, this may seem counterintuitive to some, but the premise of this is that claim values ultimately recovered in litigation cases are often far less than what one expects at the outset. And I have in previous IMCs referred to Burford's investment data to support this. Therefore, we believe that getting a known fixed return is better than getting a variable return, which may be enormous, but may also be significantly lower than the fixed return if that recovered amount is low. More importantly, though, I think our pricing thought process better matches the risk profile of an average proceeding. So on the, and I've tried to demonstrate this using the table on the right-hand side of this chart, which is an illustrative profile of an approximate risk profile of a litigation case as it goes through the various stages. Now, at the beginning, there are lots of unknowns, but as the case progresses through the litigation, the risk lowers until the dip, the low point, before the work for trial starts in earnest. Now, this is the dip because it is most likely to settle at this point than any other. Why? Because it avoids some of the major risks that come after this point, being the trial risk, the judge risk, the idea that the judge wakes up on the wrong side of the bed on the day of the trial, the recovery risk upon a successful judgment, with the enforceability, so being able to enforce that judgment against the losing defendant, duration risk, and so on. There are quite a lot of risks that materialize. So if the case doesn't settle at this point, at the dip, and it goes to trial, the risk therefore increases. Now, this dip may be the best time to settle, but by definition, a settlement also means the recovery will also be less. Now, funders with share of the awards will be therefore very sensitive to that settlement being not high enough to make them a good enough return. And in fact, Burford, I think on their last Capital Markets Day, actually said precisely this, which is that they actually like cases to go to trial because the returns they can make if it goes to trial are much higher. Now, that may be true and that may work on the cases that they invest in, but certainly the risk is greater. So the return needs to be significantly greater to justify this additional risk. The problem is if the settlement amount is too low, then in our minds it becomes more a case of, well, nothing to lose, rather than an actual calculated risk-reward decision. So for that reason, we feel charging a share of the award actually misaligns us with the actual risks of a case. If you consider that approximately 90% of cases settle before trial, so that if a matter goes to trial, we believe we'll miss out on that most viable exit point. Perhaps just the last point worth saying, though, is that we may still charge a share of the award if it goes to trial. So if the award amount is greater, we can still benefit, but without necessarily discouraging a viable settlement at the low point of the dip. So really just to summarize then, where we are after 20 months of trading, being from our launch in May 2020 to the end of December 2021, we had 517 inquiries. We made 11 investments, of which one case has completed successfully. We've got 10.5 million of capital committed across those and 3.6 million of cash deployed. We have also made 6.4 million of investor sales, which has given the business an excellent start for its first 2 years of business. Now, the final slide, which is the arrangement, the co-investment arrangement that you would have seen us announce earlier this week. We wanted to walk you through this at a high level to show why this is a hugely valuable and exciting transaction for us. So as we said in the RNS last week, this co-investment arrangement is one which we have entered into with an institutional alternative investment management firm, whereby in every investment that we make, the co-investor via an SPV will invest in 75% of that investment, leaving Lionfish with 25% of that investment. Now, at this point, I could very happily finish off and say that's fantastic because it allows Lionfish to invest in more cases without having to spend more capital. And it allows us to build a more diverse and granular investment book. However, there's more to it, and this co-investment arrangement gives us another potential revenue stream too. The reason for this is that the co-investor here has a conservative investment strategy where they prioritise a lower risk, even if it meant a lower return. So under the arrangement, the co-investor benefits from an insurance policy which de-risks them by protecting their investment. And because they are therefore de-risked, they're entitled to a lower return, which I've tried to show on the first chart on the right-hand side at the top. So looking at that, the co-investor receives a priority return, which is in the single digits percentage-wise. Then after the investor has received that priority return, and after other costs and expenses have been paid, the co-investor and Lionfish share in the balance of what's left of the returns, with Lionfish receiving approximately 90% and the co-investor receiving 10%. So this structure therefore means that both the co-investor and Lionfish both receive returns on a risk profile which are in line with our respective investment objectives. On the one hand, the co-investor effectively is protected against losses, but where cases are successful, they get back an attractive return and the kicker. As far as Lionfish are concerned, the net benefit is, as we've tried to illustrate using the bubbles on the bottom right-hand side of the page, which is that for every investment we make, we not only make the normal return we would have done on our 25%, but we make more because of what we make on the co-investment arrangement, effectively magnifying our revenue stream. Now, there are three important things to say about this arrangement. The first is that we have always said we don't want to be under pressure ever to deploy capital. We only want to invest in cases when we identify cases that we like. Now, many in the litigation funding market might think 20 million is a small amount, but candidly, worrying about deployment is in direct conflict with maintaining high underwriting standards, in our opinion. And we're very happy with the size being a healthy amount, which doesn't give rise to that conflict. The second point is that we retain sole discretion in respect of the investments we make. Now, there are obviously parameters in the structure, but the reason why this relationship with the investment firm works well is because the agreed parameters are in line with Lionfish's current investment parameters. Therefore, there is nothing which is restricting us or conversely pushing us to go beyond what we would otherwise be comfortable with. And the third point to make is that the reason why the co-investor has been able to benefit from an insurance policy is because the insurer, who is a well-established player in the space, has underwritten Lionfish's underwriting process and Rosenblatt's track record in picking winners. So this transaction it provides validation of both of our existing businesses. So to summarize, this arrangement is creative, it's innovative, but it's also very attractive in that it gives both the co-investor and Lionfish a return profile which suits our respective investment strategies. It's also a transaction which we've been able to complete because of the excellence of the banking and finance team within the Rosenblatt Memory Crystal Group, and in particular our banking finance lawyer David Sachs, who in my mind is the best banking and finance lawyer I've worked with, including during my time in investment banking. So in that regards, I mean, this transaction really does represent the best features and the best assets of the group overall. So to conclude, it's a very exciting transaction, one that fits all the parties' objectives very well, and one that sets Lionfish up very well for the future. I hope that's been useful, and on that note, I shall hand back to Nikki.
Oh, I've been muted. Thank you, Tets. And I just wanted to finish off or round up by saying that I've said from the very start when we took this business to market that I believe that the litigation funding market had room to evolve and had to change, and that it has become very fixed in this, as Tets has outlined, high risk strategy of relying on multiple returns out of a final award, which, as you can see from our very good graph there, it is at the highest risk point of the strategy. And I feel that in Lionfish, we have both successfully repriced our litigation finance, and with this arrangement, we will continue to be able to pursue our strategy of wanting to make litigation finance priced in an affordable and value for money position, and also to not be under the deployment pressure that other traditional funders are under. And that concludes our presentation for today, and I'll be happy to take any questions. Mark.
Nicola, Tets, thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Nicola and Tets take a few moments to review the questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard, and we'll notify you when that's ready for your review. Nicola, Tets, as you can see, investors have been very generous in submitting questions to you as usual. If I may, Nicola, could I hand back to you to read out the questions and give a response where it's appropriate? Thank you.
Richard G asks, the market doesn't seem to be impressed by the litigation investment arrangement. Do you think the market is underestimating the significance of this news? Also, how undervalued do you think the company is? I think the market, the market did react in a small way to the announcement. I think it wasn't material because it doesn't change our numbers for now, and it does change the longer term potential returns. So I do think though that the market isn't pricing in the lionfish piece almost entirely, to be frank. I think the fact that it's priced in the de-risking, the investor sales, but we're not pricing in the potential returns at all. So I don't think we're seeing value for the investment in this business yet. So as a result, I do think the company is undervalued, and our brokers are pricing us at £1.60 today, and I support that valuation. Michael D asks, thanks for the clarity today, very helpful. How many cases can you manage under your current structure, and what do you need to scale this further? Tets, can you take that one for me?
Sure. We actually recently made an excellent hire, someone who's very experienced in the insurance and funding market, and that really helps kind of bolster our ability to operate. But fundamentally, first and foremost, we run a very, very efficient business, which is designed to be able to process through quite a lot of cases in a short period of time. And as you know, we have an arrangement where Rosenblatt do the legal assessment for us as well. And so we have an operational setup which is really designed to process cases very quickly. The great thing about our assessment process is that no one is incentivized to waste time on cases which are unlikely to succeed. So we're quite brutal in rejecting cases quite early on. And that means, therefore, that we might get a lot of inquiries. We will also be very brutal in just cutting them out very early on, so we can spend the time where it's relevant. One of the kind of the internal metrics that I always think about is how much time we actually spend on cases that we actually don't write business on. And we really want to minimize those minutes spent on cases where we don't end up writing. And so that's quite an important consideration that we have. In terms of how many cases we can do, I mean, I think we're well positioned to take on quite a bit more.
Thanks, Tets. And David B asks, are you pricing to favour cases with a timelier settlement?
Yeah, so I mean, yes, to some extent. When it comes to the nuances of settlement, I think we always have to assume that cases go through to trial. So we will cautiously look at what the settlement profile is. As you might expect, every litigant expects their case to settle almost immediately because the other side will realise what wrong they've done. But in reality, we always have to assume and underwrite to the worst case scenario. So we will factor really the pricing into more to the end rather than to any potential settlement scenario. And
on that basis, David asks again, are you thus looking to reduce the anticipated 2-year case timeframe?
I mean, I would love to reduce the anticipated 2-year timeframe. I think everyone would. It would enhance our returns and we would have a much greater churn. But litigation is a process that we can't control, certainly as funders. We're not in a position to control it. But yes, we would always like to have cases that turn out to be shorter. I think the 2-year time horizon is made possible because we don't focus on the ultra high value claims. And as I said in the presentation, if we were backing a case which was 3 billion in claim value, then you can bet your bottom dollar that the defendant is going to fight it out and drag it out until we are 3 generations further on. The reality is we don't tend to like those cases precisely for that reason.
Thank you, Tess. And Gavin asks, and I'm going to give this to you as well. whether there's an indication of the premium that we've paid for the insurance, and might that insurance premium fall if there is more success shown?
I think in the longer term, I mean, potentially, I think as far as this transaction is concerned, it's already been pre-agreed on the basis of how they have assessed our risk. So our risk being Lionfish's underwriting process and Rosenblatt's track record.
So it would affect a further deal if we were to do one in the future, do you think?
Yes, very possibly. I mean,
and on that basis, we're being asked whether further, by Gavin again, whether further SPVs can be struck and whether they would be at 20 million or more. I think our indication is that we can do this again. At what level do you feel that you think that would be achievable?
I think I've generally tended to look at it the other way around, which is, what is the right amount for us to do so that we can invest in the cases we like? I mean, especially the legal industry likes to think of more being better. I mean, I generally tend to think that when you're making investment decisions, you don't want to be put under pressure to deploy money. You have to be willing to walk away from cases that you might otherwise contemplate doing if you had too much money.
I think the market doesn't realise that we decided the number, didn't we? We applied, and one of the things that I didn't say in my conclusion, which possibly would have helped, is that this is very much an out-of-the-box structure that hasn't been done in our industry before, and is Tetz's brainchild, and therefore it was him that structured how this looks in terms of both the size of it, the fact that it's capital protected or insured, and the fact that it's secured and giving us a single-digit return. So that has been very much driven by Lionfish. Mark L asks, read the co-investment arrangement. At what point do costs, either litigation costs, come out? Before or after the co-investor return? Is the arrangement on a case-by-case or portfolio basis? If a case is lost, do we bear the whole 25% of the loss? I think what you're asking is litigation costs, effectively the costs of the litigation are funded by the amounts that go out, up to 25% by us and 75% by us. So when you get a return, they are effectively, it's within the return, isn't it, Tetz? We include it within the return on capital invested.
Yeah, so I can't see the questions because
yes, it's a bit of a confusing question. He's asking if the litigation costs come out before or after the preferred co-investor return, and effectively it isn't done like that. My understanding, and this is great because I'm asking you now, Tetz, myself. My understanding is that they've put in 20 million, and if all of that is deployed, the first 20 million back, regardless of what it is, repayment of capital or returns on other cases, are effectively repaid to the investor, the co-investor. Is that correct?
Yeah, so exactly. So if we just kind of break it down onto two levels, I think just to clarify any misunderstanding or confusion around our 25% and the co-investment arrangement 75%. Our 25% is as if that is our risk. So a case performs well there, we get the return on that 25% portion. And that's got nothing to do with the co-investment arrangement.
And if it fails, it's lost, it's naked.
It's naked, exactly. It's a loss. We take the loss for the 25% investment that we've made. The 75% that goes into the SPV, that is done on a portfolio basis. So that is all packaged. So that all goes into effectively one funnel. So if there is a loss, yes, there are benefits of the fact of the co-investment arrangement that there are other deals in there which may be winners. And that is what drives the risk and the return profile of the co-investment arrangement.
Yes, this is what's so clever about this structure from our point of view, is that the money that's secured to the co-investor is effectively repaid out of whatever comes back, regardless. It's not allocated in that way. So it is a portfolio. It's effectively over a portfolio because they cap their investment at 2 million. So effectively, that's the maximum they can do per investment, creating a portfolio. So I hope we've answered that, Mark. But if I haven't, then do come back further down.
And it's just probably worth saying that is why this is not a credit or a debt facility. This is entirely separate from the RBG balance sheet.
Yeah, entirely. Martin asks, what percentage return would you be targeting per year with your litigation model? So, Tetz. I ask him this question in board meetings, so thank you.
Obviously, time is a big factor. I mean, generally, we are looking at making 2 to 3 times return on monies on any individual litigation investment that we make. And we price according to the risk. Sometimes it might be more, sometimes it might be less, because it might be there might be more competition involved. Sometimes it's what's required to make the economics work, but the risk justifies the lower pricing. But broadly speaking, we're looking at making 2 to 3 times return on money, wherever possible, and sometimes. But we will adjust accordingly, up or down wherever possible or wherever required.
Thanks, Ted. So David B asks again, are you looking to specialise in any specific area of the litigation funding market, e.g. insolvency, business dispute or anything, Tets?
I don't think that, so my personal view, and I think it's shared across most litigators, is, a litigation case, even within one kind of case, can often be very different because of the specific nuances to that matter. I mean, the fact that you've mentioned insolvency, I assume is in reference to the fact that Manolete might have a very insolvency-focused model. I mean, it is possible that you can focus on one particular sector. The kind of investments we do, though, are very different from Manolete. I mean, Manolete do lots and lots of small investments. I don't know how many investments they have, but I think it's a couple of hundred, and each investment commitment is quite small. Whereas we're doing slightly large. Well, we are doing larger cases, a far smaller number of cases, and a bigger commitment per case. So it's not in our interest to be so heavily focused running the kind of investment book that we do in any one particular area. Really, the starting premise is always: is this a good litigation case, and is it an investable proposition?
So Alan asks, now that a funder will pay 75% of the cost of a case, could you afford to take on 4 times the number of cases? Do you envisage scaling up the volume significantly? And if so, is there an increased risk of a higher acceptance rate? I just want to say before I give this to Tets that effectively, we had an amount that we were prepared to invest off balance sheet, and that amount hasn't changed. It represents the 25%. So our investment profile hasn't changed. What has changed is that we are effectively using an investor's money to leverage more returns for Lionfish without committing more of our own funds. So it's not a question of affording to take on more. I think in terms of scaling up the volume and the increased risk of a higher acceptance rate, this is a debate we do have internally. Tets has a very high attrition rate. It's higher. I mean, it's in the 90% at the moment, a very high attrition rate. So, and ultimately, I've seen from sitting on investment committee that he runs those principles regardless of what our deployment position is. And Tets, I'm sure you'll want to add something to that.
Yeah, I mean, I think it's so important, and this is why we as principal investors are different, I think, from a lot of the traditional fund managers who are managing external monies. I mean, we don't make monies because we deploy lots of money into cases. We make our revenue because we win the cases that we invest in. Therefore, it's much better that we invest only in a handful of cases and they're all winners rather than deploying lots of money but losing, because we don't make any money on cases that we deploy.
This is a great question, isn't it? Because this is precisely why Tets and I don't like the 2 in 20 model, because it focuses the investment manager in the wrong way. And we are focused on success all of the time. Yep. David asks us, do you anticipate needing to further expand this financing arrangement or recycling capital? And just from an RBG perspective, we see this as something that can be broadened and expanded once we've sat down and seen what how this particular SPV works over the next 2 years. In terms of recycling capital, we've always said that on returns into the group, we would look at our overall position and consider special dividends as well, depending on the return profile of both Lionfish's investments and RBGLS's investments. Tets, do you want to add your views on further financing for Lionfish? Are you happy that I've answered that?
Yeah, no, I mean, the only thing again is just to stress the point, because I think it's very important that we are driven by the quality of cases that we see rather than an opportunity that we're chasing just so we can deploy more money. I mean, it really underpins everything that we do.
Given as we've spoken, everyone, today about the fact the market doesn't price in or recognise all of the Lionfish work, there is absolutely no point in rushing around getting more finance arranged if there aren't the cases there, because we won't get recognition for it anyway. And so from our point of view, it's really about what will make us money and only deploying what we need. Emmanuel asks, for the market skeptics, when do you think Lionfish will deliver financial results to prove them wrong? Already in 2022 or only in 23? we're of the view that we will see, I'm of the view, and we've certainly done the profiling, that we will see some results in 2022 and obviously in 2023. Tets, you'll support that. I've seen your models. Yeah, that's currently what we're looking at. So Mark, and actually on that point, just to remind the market that we have said publicly that we will cease our investor sales, and now that we have this new financing arrangement, in order that, and therefore we will be forecasting an element of our returns into the market going forward. And this is already in the broker's forecast. So Mark L asks, is the insurance based on a case by case or on a portfolio basis? Are the insurer's losses on a case X recovered on case Y?
Yeah, so it's a portfolio insurance policy. So it's not, so yes, there's the principles of cross-collateralization, correct. If a case is lost, that doesn't necessarily trigger it because you've got the opportunity to recover them through the wins of the other cases.
Alan asks, I believe RBGP's long-term success rate on cases is 86% over 30 years. Would you hope for a similar long-term win rate for Lionfish or something lower as different lawyers are managing the case? I think from my perspective, and obviously Tets will step in with his views, it's Rosenblatt's success rate, by the way, just to clarify to everybody, that we're quoting there on its litigation investments, i.e. where the solicitors worked at risk, i.e. for no win, no fee, or put their own money into cases. I personally, from what I've seen on both models, believe that we would be looking for something similar out of Lionfish, certainly 75% plus. And the reason for that is because when we look at Rosenblatt's statistics, the losses are all at trial. Obviously, and Tets's pricing model is all about the sweet spot of recovering when settlement discussions are happening and clients can see that they are going to give the funder a lot less money at this point than they would give them if they went to trial. So I think the pricing model supports a continuation of that. Tets, do you want to add your views, please?
Yeah, I think that's right. And I mean, before Lionfish, I also ran an AT insurer, and we had quite a lot of cases. And the reality is that a large number of cases do settle. I mean, that's really the best kind of investment profile to have. And obviously there will be losses, and they will usually be the ones that go through to trial, unless if something's been so terribly underwritten from the outset, which we don't foresee us doing. But when there are losses, and there will be losses, they will obviously come through. But as and when, it will generally tend to be towards trial. I mean, looking at insurers, I mean, no insurer publicly shares their data, but I think it's general market convention that insurers are looking at usually loss rates between 10 to 20%. I think Rosenblatt's track record of 86% is very much in line with that, and I think we would expect our loss rates to be in line. I mean, perhaps one useful reference point was Burford's investment data, which I think when I looked at, which is publicly available, by the way, but I think when I last looked at it, which was to the end of June 2021, I think of the completed cases, they had lost about 30%, which I wouldn't say is out of kilter with
but that might reflect the fact that they are pushing to trial. That the fact that that's a slightly higher loss rate than Rosenblatt has had, by way of example. So Gavin is asking how you're remunerated, Tets, for your efforts. So I think I better answer this one. So Tets obviously has a basic salary. He has a bonus structure that's based on a percentage of our returns. I think it's around 1% of returns. And also he is a shareholder in Lionfish, and therefore he gets a dividend annually on our profits, in line with the fact that we are very focused on cash profits. And those dividends are only paid out of cash. So if there is any fair value adjustment that creates a profit that is been delivered on an unrealized non-cash basis, it will not be taken into consideration, and we will vote a dividend in accordance. And I know Tets supports that to both RBG and to Tets on the basis of what our cash profits are. Emmanuel asks, for each investment done by the alternative manager, and I think you mean by the investment partner, we actually manage the SPV, don't we, Tets? We are the investment manager of the SPV. So for each investment done with, I would have thought, the investment partner, typically how many cases in the portfolio so as to diversify risk? Well, effectively, if your maximum's 2, it's 10, isn't it? Is a minimum. But obviously we won't, it's unlikely we'll be doing every deal at 2.
Yeah, I mean, actually, it's done the other way around, which is that what they didn't want was us to be using them only to stick in the deals that we didn't really like. So to avoid adverse selection, they actually have to do 75% of every deal. So if a case comes to us and it's a £400,000 deal, then they'll have a £300,000 investment. As much as if we have a 2.5 million, then they'll be in for just under 2 million. So it really is quite varied. But the idea is it could be of any amounts up to them, and we would expect, the average ticket size to be between £1 million and £1.5 million. But we'll see what good cases come through the door.
And David, who I want to thank for always giving us so many questions, because otherwise we wouldn't have nearly enough to talk about in these sessions. So we've got another 3 questions from David. You're targeting ×2 ×3 invested capital. Do you have a target threshold internal rate of return for your pricing method? That's definitely you, Tets. I'm not answering that one.
I mean, yes, we do. I mean, the IRR metric does tend to peter off, obviously, with duration, which is why I'm so sensitive to duration. And quite frankly, I don't think any of you would give us any credit for anything that may happen, beyond 3 years from this point. So it does naturally tend to skew off. From an IRR perspective, obviously, as high as possible, we do have an internal. Very early on, we agreed a kind of a minimum that we should really be looking to get over the lifetime. But given the way that we price, it generally tends to be greater at the front end anyway. So we're comfortably in excess of that in terms of the returns that we make. I wouldn't be comfortable, I think, kind of trying to explain our pricing more, bearing in mind I think there might be some competitors on here.
And there are, indeed there are. So I quite agree. David also says, as you've mentioned, financial institutions seem to be fairly skeptical on litigation finance. Do you detect any change in attitude? By financial institutions, David, I think you're referring to our institutional shareholders and the market's reaction. If I've got that wrong, can you just type that in? But in terms of the institutions that I deal with, I think there is support for what we're doing. For the key financial institutions that work with us, and the largest, obviously, Miton. They've been here before with Burford. They have been, they may still be in Manolay. So they're very supportive. So there are certain key financial institutions that are very supportive of the process that we're taking. Thanks, David. And we are, told regularly, keep going. It's about track record. Put down our track record, show that it works, and the market will eventually go with us. So I think where we're suffering is not the key institutions who do the work, if I could just say that. The analysts do the work. It's maybe in that mid-sector of investor that doesn't put the work in and doesn't really understand everything that we're doing. Because I've often asked the question of institutions, of analysts, of some of yourselves, actually, why you think we don't get value for money. And in my opinion, it is a little bit to do with the fact that we've got several businesses within the group. And that just means that people have to do a bit more work. And it's easier to go somewhere where you don't have to do as much work. So it's my job to make this as accessible and as easy to understand as possible. And I will be continuing to work with this superb platform that Mark has created over the course of this year to continue to bring you the opportunity to learn more about our group and how it works. And hopefully by getting the message out there and spending, and I know institutions do follow this as well, we will hopefully finally get our message through to the market.
That's great. Nicola, Tets, thank you very much indeed. And thank you to all those investors that submitted questions today. And Nicola, I think you've addressed pretty much every single one that's come through. So thanks once again for your time. I know investor feedback, as usual, is very important to you, and I'll shortly redirect investors to provide you with their thoughts and expectations. But if I may just ask you just for a few closing comments to wrap up with.
Closing comments. Can I just remind everyone of our results will be on the 28th of March, and we will be doing both an IMC presentation and Mello again, and hopefully we will be doing our results presentations in person in the city. So hopefully we will be following up with, I know that Mello are trying to do one in person in the spring, and hopefully I'll be able to get to meet some of you in person finally after 2 years of being stuck in this office, which is deeply dull.
That's great, Nicola, Tets.
Thank you.
Thank you once again for updating investors this morning. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of RBG Holdings, I'd like to thank you very much for attending today's presentation, and good morning to you all.